Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 17th, 2025. Hey, how you doing? I appreciate you being here. I hope you had a good trading week. I hope you're having a nice weekend, and I really appreciate you coming and investing and spending the time here to watch my weekend review podcast. In this podcast, the format is as follows: is first of all, we're going to run the U.S. legal disclaimer. Secondly, we are going to come back. We're going to take a look at all the trades that I made last week, all the entries, all the exits, of all the swing trades that I currently have. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences were, and then how I set up and structure the trade, how I position size, how I place my emergency stop, how I place my end of bar stop, where I get into trailing stop mode, how I take partial profits if the market gives them to me, and then ultimately, if we get up to significant overhead resistance levels, how I am going to exit the trade. So I trade both on the daily time frames, the weekly time frames. So we're going to talk about all the trades. Had some good trades, had some losing trades, but we'll just talk about when we entered and then how I am going to manage them going forward. In general, with trading, you're going to have winning trades, you're going to have losing trades. But the key is you need to have a structure and a process in place so that when you're wrong quickly. And when you're right, you have a process that you follow that can keep you in a large winning trade. Because if you're trading correctly, you're patient, you wait for a setup, you wait for the signal, but you need to have a good risk to reward ratio that tells you, okay, I'm wrong quickly. I'm right, I stay in the trade. Because in the business of trading, your business expenses are your losses, right? I'm sorry, your business expenses are your losses. Every company has business expenses, right? They have revenue and they have expenses. But in trading, your expenses are your losses. And just like with any business, you want to try to keep your expenses low. And your winning trades, that is your revenue. So you're going to have winners, you're going to have losers, but you need to have a structure, you need to have a process in place that allows you to have some really big wins that are going to pay for all those inevitable losses that you're going to have. All right, so we'll talk about when I entered the trade, why I entered the trade, and how I'm going to enter or manage the trades going forward. After that, we're going to talk a little bit about trader psychology. Most important skill in trading is the ability to create a plan and to follow the plan. That's really what it comes down to. And I've been trading for over 30 years, and I just know. I mean, I deal with students all the time. I deal with traders all the time. I deal with myself all the time. And really, the way to get it done in trading is you should have a systematic trading plan in place that is followed exactly with precision. Keep those losses small, let the winners run. And it all comes down to you. It all comes down to your psychology in your mind of, can I follow this? Or to follow this process. So I always like to talk about trading psychology. It's helpful for me to teach. It's always helpful to teach, right? And I hope it's going to be helpful for you to hear, because if you want to be a long-term profitable trader, you've got to have a decent, really, and I'm not using the word decent flippantly, but the trading strategy is not as important as following it. So we'll talk about that. And like I said, hope that's going to be helpful. After that, I have gone down through my master watch list. I do that every Friday night. I go down through my master watch list and I identify potential markets for the upcoming week that could potentially have some really nice combinations or confluences of signals. These markets that I'm going to show you are not there yet, right? But when I look at these, I look at the chart and say, gosh, if next week this particular stock, XYZ stock, gets to there, then we may have, deep dip buy signals. We may have bullish order block signals. We may have bullish divergences. We may be in certain RSI levels. So one of the greatest advantages you have as a small retail trader is the ability to sit on the sidelines and wait for the market that you're trading to get to the confluences of levels that you want. If they don't get there, well, you don't have to take the trade, right? But if they do get there, then consider taking the trade because it's gotten to kind of the sweet spot. So I'm going to show you the sweet spots that, based upon the way that I trade, that I am looking for. And these markets are getting fairly close to those levels. So I hope that's going to be helpful for you. I hope it's going to give you kind of an insight into how I look at the market, how I like to combine things, looking for those confluences of signals happening all at the same time. And if it is helpful for you, I would really appreciate it if you could hit the thumbs up button. Helps to build the channel, helps to keep the channel in round, lets YouTube know that there's some potential, or there's some valuable content here. And if you haven't subscribed, I would really appreciate it if you could subscribe as well. So let's go ahead, run the US legal disclaimer, get that out of the way, and then we will get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Well, let's get started. Let's get started on the current swing trades, the current open swing trades that I am in. And I'm going to talk about how I set up the trades and manage them and all that kind of stuff. And let's start here with QQQ. So I did buy QQQ all the way back here on the 8th of April, very near the lows. And the reason that I entered this trade, this is based upon a bullish order block. So I bought all the way back here at 416.26. So why in the world did I buy down here when the news was so bad? Felt like the world was ending. Why did I buy here? Was I lucky? Well, I don't think so. I bought because there was a legitimate signal that rejected a level, a key level, and let's start with that. So I bought here 416.21. Why? Well, you see this green box here. This green box is what I base the trade upon. This green box is what is called a bullish order block, and this bullish order block started all the way back months and months ago. Let's go all the way back to why. I think it was a long time ago. Let's go. So I'm just scrolling back. This all started based upon the bar of 419.24. It's over a year ago that I based my recent trade on. So what's so important about this bar back on 419? This is the lowest bar close before we had a market structure change to the upside. So what is a market structure change to the upside? You have to look for a low, and you have to look for a lower low, and then a market structure change. So we need to look for a low, we need to look for a swing high, and then we need to look for a lower swing low. So swing low, swing high, swing low. But the key is this second swing low has to be lower than the first swing low. So here's your swing low here, here's your swing high here, and here is your swing low here. So as soon as this pattern formats itself, then we are waiting in the future for the price to take out that swing high. So swing low, swing high, swing low, and then we need to break above that swing high, and that happened here. No coincidence that this big bar was a big bar up because it broke above this swing high. So now you have changed market structure from bearish to bullish. Swing low, swing high, swing low, Now you need to take out that swing high. We took it out. Now we know that this is a bullish order block. Again, lowest bar close that happened before market structure change. Market structure change happened here. Therefore, the high and the low of this bar become the order block. And that is what you are seeing here with this green band. So essentially, now in the future, if you come back to this order block, that is the buyable area. And, I teach one-on-one lessons to people all over the world. And when I teach this, I always mention, look, let's go back over here. 7/11/24, market sky high. Well, in hindsight, would you agree that the smart money was buying here? I mean, you can see it after the fact, right? Hindsight's 2020, but when the market finally got up here, you can go back and you can say, you know what? Smart money was buying here. So I call this, we call these order blocks, but I could also call them smart money areas of buying. So clearly, smart money was buying here. If it comes back down to that area, it's coming back down into the area where smart money was buying previously. Now, that doesn't mean that things can't change and maybe smart money won't be buying here again in the future. That's certainly possible. But initially they were. So if it comes back down to this area, I think there's a better chance than not that that's still a smart money area. So here we go. Here's our, the high here is 422.75. The low is 413. Anywhere in this area is the bullish order block. So if we move forward in time, if we get back down to that level, that's probably a decent place to buy. Look at this. It's just unbelievable. On this big sell-off, where did the money start buying again? Right when it got back down to the order block. Isn't that something? And I don't just see this every once in a while. I see this time after time after time. So in my opinion, it would be good for you to learn how to trade order blocks. I trade them all the time. I trade them with options, covered calls, credit spreads, swing trades. I use them for everything, bullish and bearish. All right. So lowest bar close, market structure change. I didn't take the trade here. I'm just illustrating that after this huge move down, look exactly where we bounced was at the order block. And then it just continued to go up from there. Okay, so coming now into current times, when I bought the trade, did we come back to that smart money area? Yeah, we did. And that's why I entered the trade. I entered the trade here on the 8th. Why? Because we rejected the bottom of the order block. So if you reject the top of the order block, that is a legitimate signal. You can see the day before we were below the order block, closed back above the order block. That's the entry. So a rejection of the high of the order block, the rejection of the low of the order block based upon the closing price. I, on this particular day, entered because it rejected the bottom of the order block and closed back in the order block. Make sense? So that is why I entered at 416.26. Now, as soon as I enter the trade, find the signal and enter the trade, I have to decide how many shares I'm going to buy. One of the most important decisions in any trade is how many shares you're going to buy. And so let me show you the process that I use that factors in how much money do I have in my trading account, and two, what is the current volatility of the market, which is very, very important. So the first thing I do is how much do I have in my trading account? Okay, let's say I have $100,000 in my trading account. All I do is I take 1% of how much I have in my trading account. 100,000, 1% is $1,000. If it's a million, it's 10,000. If it's 50,000, it's 500, right? So 100,000, 1% is 1,000. And then I divide it by whatever the value, the average true range, 2 times the average true range value is. Right now it's 2027. Back here, it was much, much higher. Well, let me just show you. This is actually a good teaching moment. At the moment, when the day that I bought it was $28.68. So $1,000 divided by 63, excuse me, told me to buy 34.9 shares, so just round that up to 35 shares, okay? Volatility was so high that it had me buy only 34.9 shares. Conversely, if I were to buy SPY today, here we were buying 35 shares. If I was buying SPY today, look, it's only 20.27. So 1,000 divided by 20.27, now it would have me buy 49 shares. Much, much more. Why? Because the volatility is a lot less. So that's a perfect example of that's why I use the 2ATR to tell me what the volatility is, because the volatility is higher. This number is going to be higher and I'm going to buy fewer shares. So it's adjusting for volatility. All right. So let's go back and do, okay, so 49 shares. So the rejection of the bottom of the order block, I got long 416.26. I position size correctly, buy the amount of shares. Now, the very first thing after I buy the shares is I look at the value of the 2ATR, whatever that value was, and then I draw my emergency stop that far below. So here we'll just do it based upon this. 1,000 divided by 20.27, buying 49 shares. I enter, I place my emergency stop $20.20 from my entry price. I place my emergency stop. So if I have 49 shares and it goes down 20.27, I've lost my $1,000, right? Now, that's 1% of your capital. That's never fun to lose, but that's recoverable. But the important part to understand here is this emergency stop where you would lose 1% of your total capital only happens about 5% of the time. The other 95% of the time, your end of bar stop comes into play. So there's always two stops. There's emergency stop, which is if it does actually go 2 ATRs from your entry to the downside, that's your emergency stop, then you lose 1%. But the other stop is your end of bar stop. And your end of bar stop, if you're structuring the trade correctly, will be much closer to your entry. Well, on an order block, you can see the high and the low of the order block. So the low here is 412.74. The next day, if it had just closed below the order block, even by a penny, I would simply got out for a very small loss. That's what I'm talking about when I talk about good risk to reward ratios. Your entry should be as close to your end of bar stop as possible. So again, if it closed below the order block the next day, I simply would have got out. If the next day it would have gone crashing down to my emergency stop, I would have gotten out. If it gets down to the emergency stop, I lose 1%. If it just barely closes below the end of bar stop, which is the order block, maybe I lose 0.1%, right? Okay, so rejection of the order block from a year ago, position size correctly, place my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. The next thing I do is I take my entry price and I add the value of the 1.5 ATR. So right now the value of the 1.5 ATR is 1520. So I take my entry price, add 1.5 ATR value above, and then I place this orange line. This is my trailing stop level. And if I ever get to my trailing stop level, now it's telling me to tighten up some of my stops. And I do this by saying if I get to my trailing stop level in the future, if I have a close below a previous bar's low, I will get out of half of the position. And you can see, and I'll take you through this in detail, but you can see bought here, we did get to trailing stop level. Now I have my first close below a previous bar's low. That gets me out of half of the shares that I have remaining. Just by default, that tightens up your stop, but I need it to go to at least 1.5 before that happens. Okay, so everything I have talked about so far, the position sizing, your end of bar, your emergency stop, your end of bar stop, going into trailing stop mode, this is all based upon, or these are all defensive moves. Or in other words, if the trade does something that goes against me, I have to take action. But I always like to play offense as well as defense in my trading. And the way that I play offense is I take partial profits if it moves in my direction a certain amount from the previous day's close. So I am currently in this trade. So let me show you what I am going to do for Monday, how I do that. I do this every day. I set 3 profit targets every day based upon the previous bar's close. So right now, the previous bar's close, 521.51. So I take 521.51 and I add to it the value of the 0.45 ATR. Right now, the 0.45 ATR is 456. So the closing price plus 456. My first profit target for Monday on the Qs is 526.07. Then to find my second profit target, I take my first profit target, 526.07, and I add the value of the 0.45 ATR again. So 526.07 plus 4.56. My second profit target for Monday is 530.63, and then I do it one more time. 530.63 plus 4.56. My third profit for the target on Monday only, 535.19. So I place 3 profit targets in the system as limit orders for the next day. Now the question is, how much do I sell there? It's very simple. I just sell 10% of however many shares I went into the day with. So if I went into the day with 50 shares, I would put 10% of that, which is 5 shares at the first profit target, 5 shares at the second profit target, 5 shares at the third profit target. And I do this every day. Now, if the next day it goes down, I don't hit any profit targets, right? But it's important to play offense and defense in trading, at least in my opinion. And that's how I structure all of my trades, offensively and defensively. Okay, so that's kind of an overview. And so let's just kind of like sum it all up. So I entered the trade back here, 408.2025, a rejection of the long-term order block. I entered at 416.26, position size correctly as we went over. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I placed my 1.5 ATR trailing stop level above. The very next day takes off like a rocket ship. In this particular case, I think I hit 6 profit targets. I put 3 in every day, but if I hit my third, then I have to just go in and manually put 4 and 5 and 6, and that's what happened. So it had a huge move up where I hit massive amounts of profit targets, and I also got into trailing stop mode. Doesn't mean I do anything, it just means that I'm in trailing stop mode. The next day, we went down, didn't hit any profit targets. The next day went up, hit some profit targets. Next day sideways. Next day was our first close below a previous bar's low. I took off half of the remaining shares that I had for a gain of 6.75%, right? So I tightened up my stop by taking those shares off. Next day, not much. Next day down, so no profit targets. Next day up, hit some profit targets. Next day up, hit some profit targets. Next day up, profit target, sideways, profit target, pullback. And now we've had this last huge move where obviously I took profit targets here, took profit targets here. Now on this day, on the 13th of May, I took off half of the shares that I have remaining. Why? Well, on this particular day, we went above the 70 RSI during the day, and closed below the 75 by the end of the day. So on that day, there were no more buyers above the 70 RSI. For me, the way that I trade, that is a signal to take off half of the remaining shares that I had. So on the 13th, because it rejected the 70 RSI, I took off half of the shares that I had remaining for a gain of 19.19%. And going forward after this particular day, if I now get a close below a previous bar's low, or I get a close below the 5 EMA, now I'm completely out of the trade. Those are the rules that I have. Every strategy I have has very explicit rules that I follow meticulously. I use these, I teach these, and they're all there for a reason. So here on the 14th, again, half the remaining shares that I had for a gain of 19.9%, and then the remaining shares that I have left on this trade up 20.24%. So really good trade, all based upon this bullish order block. And more importantly, I have a process that kept me in the trade. Even though it was getting high, it kept me in the trade. And look, this 20.24%, it's going to pay for a lot of little small losses that I'm inevitably going to have. Okay, so this was Qs. I spent a lot of time on this particular trade. Going forward, it's going to be much, much faster. Okay, but hopefully this is helpful on the Qs. Okay, next trade is on Google. Okay, I entered Google here on this day, on the big down bar day on the 7th. Why? Well, here you see the green block. This is the order block. What makes it an order block? Well, this one's more recent. Let's go back here. We have a low, swing low. We have a swing high. We have a swing low. And then do we take out that first swing high? We certainly do, right here. We take it out. Now we have changed into a bullish market structure. So if you are looking, where was the lowest bar close before market structure change? Here it is, the lowest bar close. Going forward out here, you can see on this particular day, we went into the order block, closed back above the order block. That was the entry. So I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of this order block. I placed my 1.5 ATR trailing stop level above. And now I know exactly what I'm going to do in this trade, regardless of what happens. If it goes down and hits my 2 ATR stop, I'm out. If it closes below the low of the order block, I'm out. If it moves up 0.45 ATRs, at least from the next day, I take profits. If it gets up to my trailing stop level, then I go into trailing stop mode. So fortunately, I got it right at the right price. It gapped open, hit some profit targets. Next day was down a little bit. Next day up, profit targets. Next day up again, not enough for a profit target. On the 14th, I hit multiple profit targets, and I'm in trailing stop mode. So it means now in the future, if I have a close below previous bar's low, I'm going to get out of half. The 15th, sideways, and then on Friday, gapped up nicely, hit multiple profit targets. So I'm in trailing stop mode. It has not closed below the previous bar's low, and this particular trade doing nicely, up 8.89%. Based upon this bullish order block. Pretty nice, right? Okay, Amazon. Amazon is a trade that I took on Friday. Why did I take this trade? Well, haven't talked about this for a while, but this is what is called a bearish island reversal. So bearish island reversals and abandoned babies, there's bullish and there's bearish abandoned babies and bullish or in bearish island reversal. This is a bearish island reversal. So what is a bearish island reversal? It has to do with a gap up. You can see Amazon gapped up big time, then moved sideways, and then had a gap down. You see how we have a gap down here? Gap up, gap down. So when you have big up push in sentiment, bullish sentiment and then you have a gap down soon after that, that, in my experience, shows you in the future you are going to be lower. Conversely, if you have a gap, look at this abandoned baby here. You have a gap down, so things, for whatever reason, overnight were bearish, followed by immediate gap up. Again, like I said, in my experience, if you have a gap down and a gap up, you look in the future, more times than not, it's going to be higher, which it was. But this is the opposite of this. We have a gap up, followed by a gap down. In my experience, more times than not, it's going to be lower. So how do I structure this trade? This particular strategy, by the way, is a little different than the rest. I don't take partial profits. I don't go in a trailing stop mode. This one's kind of a set it and forget it. So if I have a bearish, or if I have a baby trade, or I have a island reversal trade, this is all I do. I wait for the signal, I position size, I place a 2 ATR stop above me, and I place a 4 ATR profit target below me. That's it. One of two things are going to happen. I'm going to lose 2 ATRs, or I'm going to make 4 ATRs. Is the risk to reward ratio good? It is, because if I'm right, I'm going to make twice as much as if I lose. But I'm only initiating the trade when a certain pattern has taken place, which is the island reversal. Gap up, some sideways, followed by a gap down. So that's it. 2 ATRs above, 4 ATRs below. And if you'd like to learn more about island reversals or abandoned babies, you can go to my YouTube channel. I have in the lessons playlist, I have a video on island reversals and abandoned babies. And one of my favorite, really one of my newest favorite trading approaches. And also, by the way, if you're interested, I do teach private one-on-one lessons. I teach students from all over the world. I teach a 15-hour course where I teach you all 7 of the different trading approaches that I use. I teach you all the rules. We do a lot of simulation trading. It's a great course. It's not easy. I mean, you're going to learn a lot. It's not an easy course. It's intense. But when you're done with that course, you will have learned a skill you can use the rest of your life. So if you're interested, my email is in the link of this YouTube video. Just send me an email and we can get the conversation started. So this particular trade took exactly, basically even. So those are the 3 open trades, open swing trades that I have. Qs, remaining shares up 20.24%. Google, remaining shares up 8.89%. And the Amazon trade, just entered that on Friday even. Okay, now let's go to the closed trades. Now, the closed trades here did not have a great trade on Merck. And what you're going to see with my trading is winning trades, I'm going to be in it for quite a long time. 8 days, 12 days, a month and a half. The losing trades, I'm going to be in and I'm going to be out. So I was actually, honestly, I don't get too surprised with trades anymore of what happens. But honestly, this one did surprise me because this was such a good setup. I know it was news related and, you know, that had the effect. But you see the green box here. This is a bullish order block. What makes it a bullish order block? Well, here we have a swing low, followed by a swing high, followed by a swing low, and then we have a market structure change here. So this becomes the order block. The high and the low, 78.69 and 75.93 going forward becomes the order block. So once we get significantly above the order block here, if it comes down to the order block, I'm going to look to potentially enter long. Well, on this day, on the 6th, it rejected the high of the order block. Now, I did enter here, but I only entered half the position. Why? Well, just experience, really, because the bar that got us to the order block was very big down bar. That concerned me a little. So I only took a half a position. The next day, we tested the top of the order block and bounced off it again. That made me feel better about the trade, that it was respecting the order block. And then the next day, we came down into the order block. And we rejected halfway of this big up bar. So I now added the second half of my trade here. Does that make sense? So half with the top rejection at the top of the order block, half with the rejection of this big up bar here on the 24th. And so my average price is in between here, right about in between. Now, the next day it went down, but it just barely closed above the order block. It kept me in the trade. And then the next day, blast off. Now, I take partial profits every day, remember? So I hit 3 profit targets on this day. Thankfully, right? Because we know what happened after that. So this is a good example of why it is important to take some profits when the market gives it to you. So the next day I hit 3 profit to the upside. Everything looked great. Took 30% of the trade off. Then the next day we opened up down, still holding the stop loss, which is the bottom of the order block. And then this day is the day that we had the news on all the pharmaceutical stuff with all the politics. And then boom, we crashed down. And did we close below the order block? Yeah, clearly we did, right? So I had to exit the trade. So I bought half here, I bought half here. My average price was right here. So on this particular trade, I lost 6.51%. And you know, these order blocks for me are so strong, this actually really surprised me, you know, but no matter how good a signal is, a setup is, of course, it doesn't have to work. And this one did not work for sure. And so I lost 6.51% on this. But, you know, a little bit of a saving grace here from a teaching standpoint is this day on the 12th when it had the huge rally back up. You see how important it is that I took the partial profits while I had them, because this significantly reduced my ultimate loss here because I had fewer shares and it mitigated that loss. Make sense? So on this one, a loss of 6.51%. Okay, next one, also a loss. This is a short position on ARK. Now, why did I take this short position? I got short here, 51.35. Well, you see this is a red box. Red box is an order block, but a bearish order block. So let me explain bearish order blocks. You have a high, you have a pullback, you have a higher high, and then you break structure. Just like I showed you with the bullish ones, but it's the opposite. Swing high, followed by a swing low, followed by a swing high, and then this takes out that swing low, changing this into a bearish market structure. So if you're in a bearish market structure, you come into the bearish order block, that's where I'm looking to short. And this was such a good setup. Didn't work, but it was a rejection of the high of the order block and also a rejection of the 200-day moving average, the black line. So I shorted here at 51.35. I placed my emergency stop 2 ATRs above because I'm short. And thirdly, my end of bar stop is a close above the high of the order block. Well, next day gapped up significantly and I had to exit the trade. How much did I exit the trade for? A loss of 5.74%. So tough, right? Not every trade works for sure. I had such a long run of almost no losing trades. It was unbelievable. So yeah, this was a losing trade, and I guess I was due for that on the 2 trades there between Merck and ARK. But again, trading, having losses is part of trading. But let's think about here. Yes, unfortunate. I had to get out for a loss of 5.74%. What about if I had not gotten out? What about if I had not followed my rules? Well, next day, that would have been wonderful. Higher, 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 higher. Do you see why it's important that I took my stop here, right? It's never fun to lose money, but when you get out and then it continues to go in a direction against you, you're like, oh, I'm so glad I got out. And yes, I'm so glad I got out here and followed my rules. Okay. So those are all of the open and closed daily trades. Let's move on to the weekly trades. Weekly trades close on Friday, so I make my decision based upon the Friday's close bar. So TLT, I entered TLT all the way back here on 117.25 at the beginning of the year. Why? Rejection of the order block. I got long 87.20. I placed my emergency stop 2 ATRs below. Where's my end of bar stop? Close below the order block. Make sense? Okay, so also another good example of why taking profits when you have them is important. The next week goes up, not enough for an order block. Next week goes up a little bit, not order block for a profit target. Next week goes up, not enough for profit target. Next week does move up nicely, and I hit a profit target. Next week, no profit targets. Next week, no profit targets. Next week, nice strong move up. Also hit profit targets. Also got into trailing stop mode. Then we have 4 weeks where it just moved sideways, nothing, slightly down. Then we had a big, huge, strong move up here on the week of 4-4 where I took, again, partial profits because the market gave them to me. I'm also in trailing stop mode. Then we had the huge bar down that next week, and did this, remember I'm in trailing stop mode here, did this close below the previous bar's low? Absolutely, 100% did. So I had to take off half of my position for a very small loss of 0.59%. The next week goes up a little bit, enough for a profit target. Next week up again, enough for a profit target. Next week up again, near the top, I did hit a profit target before the reversal. And then the last 3 weeks, it has simply come down. So the remaining shares on this trade down 1.05%. But again, do you see the benefit of taking the partial profits when the market gives them to me? Yeah, the remaining shares are down 1.05%. But all in all, I am down less than that. So I'm sticking with the trade. I'm following the rules. But yes, this one's slightly down. Okay, let's go to Nike. Sorry, folks. Yeah, here's Nike. Okay, no order blocks. This is simply just a deep dip buy. One of the strategies that I use, one of the strategies that I teach is the deep dip buy. And by the way, I teach that in my private one-on-one course. But I also have a great video course on the deep dip buy, which is available at udemy.com. And the link to that udemy.com video lesson is in the link in my description. I've sold so many of those all around the world, got such good feedback. I think I have like 4.8 or 4.9 stars on that video lesson. And it's a big lesson. It's 9.5 hours just on deep dip buys. So, using deep dip buys, combining them with order blocks, one of my absolute favorite combinations, but this particular trade here was just deep dip buy. So I bought Nike here on the 18th of April at 55.80. Why? Very simple. On this week, we went under the 30 RSI and yet closed back above it. That by itself is a standalone entry signal, deep dip buy entry signal. It goes below 30 during the week or the day, closes back above 30 RSI. That's the signal. In addition to that, you can see this gray line here. This is the negative third ATR channel. Whenever price starts getting down to the negative third ATR channel, about 92% of the time when it gets to this negative third ATR channel, it stops going down, starts consolidating, or goes up. So in addition to the RSI going under 30, over 30 during the week, you see how we also went under the negative third channel during the week, but yet closed back above it. That's your confluence of signals. That's the confluence, and that's why I took the trade. Okay, so I took the trade here, 55.80. Position size correctly, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI. That's why I initially took the trade, right? Because it rejected the 30 RSI and then closed over the 30 RSI. Therefore, in the future, if it closes below 30 RSI, that is my end of bar stop. right? You don't have any lines here. You just have to watch the 30 RSI. So the next week it went up, had a little profit target. Next week, nothing. Next week went up a little profit target. And then this week, I also hit profit targets as well to the upside. And look, we're at the orange line. What does that mean? Now I have gone into trailing stop mode. It doesn't mean I do anything or sell anything or buy anything. It just means now I'm in trailing stop mode, which means now in the future, if I have a close under a previous bar's low, I'm going to get out of half. So next week, if we close under this week's low, what do? I'm going to sell half, right? So this particular trade doing pretty nice. This one up 11.42% on this deep dip buy here. And I'm in trailing stop mode. Let's see. Is that it? That's it. So overall, those are the trades. Not bad. Had the loss on Merck, had the loss on ARK, unfortunately. But as you can see, I got in those trades. They didn't work. I'm out quickly. I was out within days. Next day on ARK, Merck, several days out. But Qs, I've been in over a month, right? It just goes to show you. And Nike, I've been in weeks. So if you're trading correctly, in my opinion, you're going to be out of your losers in a few days. And your winners, hopefully you're in for weeks, if not months. All right. So all in all, not bad. Happy with the trades. And we'll see what happens for next week. And then we'll do a little trader psychology. And then we'll talk about the trades that I am looking for next week. So let's do a little trader psychology first. Okay. This is from Money Trade Edge, Better Thinking, Better Trading over on X. I want to thank him for this particular post. But what most people think. Most people think that trading equals gambling, right? You've heard this, right? If you got into trading, you probably spoke to some of your friends or your family and said, oh, it's just gambling, it's just gambling. Okay, for one, it's not. There are many thousands and thousands and tens of thousands of people that make a living trading, right? And they don't make a living gambling. You know, gambling is when you have a built-in edge against you, mathematical edge against you, like in roulette and baccarat and craps, right? There's a built-in disadvantage against you, like if you go to Las Vegas. So that's how they built Las Vegas, was with that mathematical edge. The reality in trading is that you are the casino. If you have a good trading approach, you have an edge, you are the casino. So trading equals edges, like I just talked about, having a mathematical edge in your trading approach, plus calculated risks, plus emotional flights, that's your emotion side, and plus consistency, plus countless hours of practice. Listen, most people lose money trading. Why? Because they're not doing it correctly. They don't have a good back-tested trading strategy that has a mathematical edge like Vegas does. Or if they do it, they don't follow it correctly because of emotional fights, right? And consistency, maybe sometimes they follow it, sometimes they don't. And they don't practice, right? I mean, I've been trading for over 30 years. I practice hours a day. I look at charts. I go through. I look for confluences of signals. I look for calculated risks, right? The ARK trade I had, losing trade, but that was a great trade setup. If I got that trade every day for 100 days, I would take that trade 100 times, because I know out of 100 times, I will make more money than I will lose. It doesn't mean I'm going to have every trade is going to be a winner, but just like in Las Vegas, they lose hands of blackjack, they lose rules of the roulette wheel, they lose throws of the dice and craps. They lose all the time. As a matter of fact, they lose about 49% of the time on average. They lose 49% of the time. They only win 51% of the time, and they built Las Vegas basically on that 2% edge. right? You can do just as well as that, if not a lot better in trading. But you have to have an edge. You have to get yourself a good process, a good strategy that has an edge. You have to calculate the risks because you're not always going to be right. Having good risk to reward ratio. You have emotional fights with yourself. Should I take this trade? Should I not? Should I follow it? Right? You have to be consistent and you have to practice. It's a profession and you have to treat it like one. You have to treat it like a business. And you have to be. I was thinking about trading yesterday when I was playing baseball. Two things I do: play baseball and trade. And the word that came to my mind was precision. In trading, you have to be precise. Your entries have to be precise, and the following of your rules have to be precise. Did it close 1 penny under my stop? Yeah, it did. Well, but it was just 1 penny. Maybe I'll just keep it. No, precision. So trading equals edges plus calculated risks plus emotional fights with yourself plus consistency plus countless hours of practice. All right. So anyway, let's try to do a little bit more of all of this and let's improve our trading. All right. Okay. Let's get on to what I'm looking at next week and see if that's going to be helpful for you. All right. So like I said, I do this every Friday night. I go through, I take a look at all of the potential or all of my watch list and I narrow it down to some potential trades that fit the way that I trade. Now, these candidates are not where they need to be yet. They're not there. Because if they were there, I would have probably already taken the trade, right? So I have to wait for these markets next week to come back into kind of my sweet spot, right? Of where I want to trade. And if they don't get there, I forget about it. I just get on to something that does. Now, the other thing I want to mention is here on the dailies, I have 8 potential setups. Now, could potentially Monday, could all 8 of these trigger? Well, they could. Unlikely, but they could. But if they do, does that mean I take all 8 of them? No. I only take 1 trade per day per time frame. One per day or 1 per week if it's a weekly trade. And, I have a lot of people ask me, why do you only take 1? I said, well, out of all 8 of these, if these all triggered on Monday, there is going to be one that's better than the rest. And how do I determine that? Well, I give it a quality score. I give each one a quality score. If Alibaba has 1 signal, okay, maybe I give it 1. If DDM has 2 signals, then I give it a score of 3. If GDX has a score of 3, then 3 signals, then I give it 3, right? At the end of the day, which one am I going to pick? I'm going to pick GDX because it has the most signals. It has the most chance of being a potential positive trade. And so I look at how many entry signals are there, what's the risk to reward ratio, what does it look like on a higher time frame, what is the relative strength of this particular market compared to the market in general, does it have any bullish MACD divergences, does it have any bullish RSI divergences, does it have any bullish ATR divergences, right? I factor this all together to come up with the best trade of the day, and that is the trade that is going to be more likely than the others to be profitable. Doesn't mean it has to be profitable at all. It could be the most perfect trade setup in the world, and it still isn't profitable. We know that, right? But over time, by picking the one with the highest quality score, over time, you're going to make more money on those particular trades than others. And again, that is what I teach my students in my one-on-one course. And I'd love to have you as a student. Like I said, I teach people from all over the world. It's a 15-hour course. I teach you all 7 of the different trading strategies that I use. I help you any way I can with your trading, getting things set up. And we do a lot of simulation trades where I teach you the strategy, I show you the strategy, I show you the examples, and then we go through random charts where you're the one telling me, Greg, we're going to take this because of this, and then we're going to do this because of that, and I'm going to say, yes, that's correct, or no, because of this, that, the other. But we do a lot of simulation trading. Whether you're if you're a pilot, you need to do a lot of simulation tradings. In trading, you need to simulate, right, to improve your game. So if you're interested in becoming a student of mine, just send me an email. It's in the link in the description. Love to talk to you and love to teach you everything that I know. Keep in mind, I also have the video course available at udemy.com on the deep dip buy video, or the deep dip buy stock trading strategy, and that's a great one too. So either between the one-on-one or the video lessons, you're going to learn a lot. So okay, let's start with Alibaba. Okay, I had mentioned on Amazon. We talked about abandoned babies, and we had talked about island reversals. Well, Alibaba just had an island reversal. Why? Well, look here. We gapped up. Would you agree we gapped up? Then we moved sideways, and then we gapped down. So sentiment, everything was very bullish to the upside for a few days, and then it kind of gave up the ghost. See how these three bars are kind of hanging out there by themselves in space? So what's the trade? Well, this may just continue down from here. I wouldn't be surprised. But when I get an island reversal like this or an abandoned baby, I like to wait for a check back. I like to look for a move back up and a rejection of the bottom of the low of that island reversal. The low of the island reversal is 130.20. A lot of times when you have those reversals, you'll have an initial attempt to go up that will fail before a big move down. Well, that's what I'm looking for right now. I'm looking for a move back up and a rejection of the low of this island reversal at 130.20. If I get it, if it just heads down, I'll miss it. But if it does have that initial counter rally back up and the rejection of 130.20, then with this particular trade, 2 ATR profit target above, 4 ATR profit target below, just like I have on Amazon. Okay, so I'm looking for a check back and a rejection of the bottom of this bearish order block at 130.20. DDM. Boy, I had a good trade on DDM. On the weeklies, all the way up here, if you remember, on the weekly charts, and I covered down here. Order block, that's what it was. Well, and that was on the weekly. But now we are coming into an order block on the daily on DDM. Why? Because we have a swing high back here in March. We then followed by a swing low, followed by a swing high, and then break of the structure to the downside, clearly. Swing high, swing low, swing high, break a market structure to the upside, makes this bar here the bearish order block. 94.68 to 93.22 is the order block area. We go out into time. Have we rejected it yet? No, we have not. But next week, if we reject the bottom of the order block, the low of the order block is 93.22. That would be a potential short entry signal for me there. You also have the 200-day moving average that is now living inside of this bearish order block. Really, all in all, my favorite setup is when you have a major moving average like the 200-day moving average, the 250-day moving average, the 300-day moving average that is also inside an order block. That makes it even more bearish. Conversely, if you have a bullish order block and you have a 200, 250, 300 moving average inside that bullish order block, that makes it even more bullish. But this here is extremely bearish. We have a bearish order block and we have a major moving average like the 200 that resides in the bearish order block. Massive amounts of resistance here. Doesn't mean it can't go through it, but it's less likely. So a rejection of the bottom of the order block at 93.22 would be a potential short. A rejection of the high of the order block at 94.68 would be a potential short, or a rejection of the 200-day moving average inside of the bearish order block would also be a really good entry position for me for a short as well. GDX. Okay. You see a bearish order block, you see a bullish order block. And before we start on this one, we were talking about abandoned babies and island reversals. Well, it's funny because I was teaching a student from Finland at the time that we did this. No, excuse me. That's Pete. Hey, Pete, how you doing? Just want to say hi to all my students, by the way. I have one in Finland. I have one in Canada. I have one in the United States. I have one in Malaysia. But yeah, it was Vivek in Canada. Hey, Vivek. But when I was teaching him the lessons right here. This is an abandoned baby. We gap up. Yes. Next day, did we immediately gap down? Yes. Did we come back and reject the bottom of the abandoned baby? Yes. And look what happened. Boom. Straight down. Right. So there's an area of resistance above us with the bearish order block, but for this particular, for right now, what I am keying off of is this bullish order block. What makes this a bullish order block? Well, over here we have a swing low, followed by a swing high, followed by a lower swing low. We have that? Yep, swing low, swing high, swing low, making this move above here a change of market structure to the upside. Once that happens, we look for the lowest bar close prior to the market structure change. This defines our order block. The high of the order block is 42.55. The low is 40.26. Draw that out into time. Are we there yet? No. Is the 200-day moving average now living inside the order block? Yes. That would make it extremely attractive to get long for me. So going forward on GDX, this is what I'm looking for. I'm looking for a rejection of the high of the grain box or a high of the order block of 42.55. Conversely, a rejection of the low of the order block at 40.26, or a rejection of the 200-day moving average, the black line that's living inside the order block. Now, I don't know if it will get here. If it doesn't, if it gets there, great. I will be watching that closely to get long. I think that would be a very good potential entry spot. Remember, you have to have your stops, right? Because it could get there and then fall right through it. You don't know. But very likely this would be a very good area. But it's not there yet. So have to be patient and wait. That's what I'm looking for. MA, MasterCard. Okay, MasterCard has just been on a tear. Look at this check mark. Down, straight up. Well, I have a red box there. Why the red box? It's an order block. Swing high, swing low, swing high, market structure change, making this the order block. The high is 581.31, the low is 569.10. Draw that out into space and into time. On Friday, we closed above the order block. However, going forward, if we close back in the order block, then that's a potential short entry area, right? With the stop then in the future being closed back above the order block. So I'm looking for a close back in the order block for a potential short. McDonald's, similar. We have a swing high. We have a swing low. We have a higher swing high. We break market structure to the downside. This defines the bearish order block. Bearish order block high is 321. The low is 313. We are right now at the moment inside the bearish order block. Is it immediate short? No. I need to see it reject something. I need to see it reject, at this point, the high of the order block at 321. So next Monday, if it goes above it and then closes back below it, then it gives me a very good risk to reward ratio. I can get short if it closes back above the order block, which is very close to it. I can just get out. Or conversely, rejection of the low of the order block, I could also get short there. Although on this particular trade, I would prefer a rejection of the high of the order block because it's kind of a wide order block and it would give me a much better risk reward ratio. Altria, lots of red boxes, everybody. Why? Because we are coming in some bearish areas. Swing high, swing low, swing high, break of market structure, making this highest bar the bearish order block. 61.26 is the high, 60.37 is the low. Is it going to get up there and reject the bottom? Maybe. Is it going to get up there and reject the top? Maybe. If it rejects either of those, then yes, I would potentially get short, but maybe it never gets there. If it never gets there, I just don't take the trade, right? So that's what I'll be watching, is for rejection of the bottom or the top of the order block next week. Philip Morris, PM. Same thing. Swing high, swing low, higher high, break of market structure, defining this as the order block, 176.49, the low, 173.15. Drawing the order block out into space. This will be a resistance area. It's potential that we could reject the bottom of the order block. That would be one potential short, or rejection of the high of the order block. That would be another potential short. So that's what I'm watching. And then UNG. I like UNG actually quite a lot. And you see a green box down here. What does that mean? That means that it is a bullish order block. Why? Well, this is a really recent one too. We have a swing low on the 22nd. We have a swing high. We have a swing low. Then the next 2 days later, we break above that first swing high. That changes us into a bullish market structure, making this now the bullish order block. Now, if we come down and reject the high of that bullish order block there at 1554, or rejection of the low at 1504, I would certainly consider taking the trade. But from a deep dip buy perspective, we are getting to the 200-day moving average, which just by itself is a legitimate entry if we get a rejection of that 200. Ideally, I'd like to have the 200 inside the bullish order block, but that's just not the case at the moment. So I'm watching UNG for two things next week. A rejection of the 200-day moving average, the black line, either a close under, close over, bounce, or intraday rejection. That would potentially get me long there. Then I'd use the 200 as my end of bar stop. Or if we go lower, a rejection of the order block here. And you've heard me talk about double bottoms, bullish divergences. Well, I can just tell with UNG, if we do come down and test this bottom, we will have a double bottom bullish MACD divergence, which is a very bullish signal as well. So if we reject the 200, I'll consider getting long. If we go lower, which I kind of hope we do, sorry to anybody that has UNG at the moment, but if we go lower, then it's even a more ideal trade because we're lower and there's that super strong bullish order block there. All right, so that's what I'm looking for in UNG. Let's take a quick look at the weeklies and then we will wrap everything up. AMD. This is AMD on the weekly. Now, these are not very close, but if they get there, I would definitely consider taking the trade. But really what I'm showing you here is on AMD on the weeklies, this week we changed market structure to the upside. Look at this low over here, swing low, swing high, lower swing low. This week we took out the previous swing high, making this the bullish order block. So good news, on a higher time frame, we have changed into a bullish market structure. So coming back down, if we were to reject the high of the order block, 97.91, I would consider taking the trade there. If we reject the low of the order block, 76.46, I would certainly consider taking the trade there. Or conversely, you see this green line inside the bullish order block? That's halfway of this big up bar day on 4/11/25. Halfway of big up bars tend to add support. So if we come a little deeper into the order block and reject that halfway, That's what I would look for. So look, this may take a week or 2 or 3 in order to happen, but I really like the change in market structure. Swing low, swing high, swing low. Taking out the swing high, which changes market structure to the upsides. And a lot of times after you change market structure to the upside, you get kind of initial pullback. That's the thing. Buy dips in an uptrend, sell rips or sell rallies in a downtrend. That's what the order blocks and these structures do. So now that we are in the bullish market structure, yes, a pullback would be a buyable pullback because buying pullbacks in uptrends is the smart thing to do. So that's what I'm looking for on AMD. First stop would be look for rejection 97.91. Russell 2000. Same thing, everybody. Swing low, swing high, swing low. We finally broke above that first swing high, giving us a bullish market structure. Now, this one seems a little bit more likely that we could get I could get a bit of a trade out of this, especially since we had the news after the market closed on Friday. So it looks like Monday initially we're going to be down. This 200-week moving average that lives inside of this bullish market structure, or this bullish order block, this is really what I'm keying off of as a likely potential trade. IWM pulling back here, rejecting the 200-week next Friday. If we've rejected the 200, bounced, or intra-week rejection closed back above, I would very likely take the trade, especially because we live inside the bullish order block. And then my stop would just be a close below the 200. So this one seems potentially likely that this one could trigger next week on IWM. Southwest Airlines, all sorts of red. Why? Well, because we had a swing high, we had a swing low, we had a higher swing high. We broke market structure to the downside, making the order block above 34.89 to 31.60 is the high and the low of the order block. But we have this nice black 200-week moving average acting as resistance that lives inside of this bearish order block. Those are my favorites. Major moving average inside a bullish or bearish order block. So next week, if Southwest moves up, rejects the 200-week moving average, that would be my short, and my initial stop would just be a close back over the 200, but we'd have to reject the 200 above us. Let's go to Morgan Stanley. Well, you see red, that means that we have a bearish order block. We have a swing high, we have a swing low, we have a higher swing high. We change market structure to the downside. Therefore, this bar here on the 7th of February, the high is 140, the low is 132.84. This now becomes our bearish order block above. I would have to reject the bottom of the order block at 132.84 for a potential short, reject the high of the order block at 140.90 for a potential short, or the red line in the middle is also a legitimate level, because back here on the 21st of February, we had a big down bar. If you have big down bars and you rally back to halfway of those big down bars, that is inherent resistance. So a rejection also of 135.10 inside of the bearish order block would be a good potential entry signal to consider. Walmart, very similar, everyone. I'm sorry, I know these all kind of look the same. Swing high, swing low, higher swing high, market structure change, making this bar here on the 14th, the high of 104.76, the low of 173. This is the order block area. So first stop on this would be a rejection of 173 for a potential short. XLF financials, same thing. Swing low, swing high, higher swing high, market structure change. The order block is 52.26 to 50.41. We are smack dab in the middle of this order block right now. Does it mean I short right this second? No. I have to reject the bottom of the order block, or I have to reject the top of the order block. So that's what I'm looking for there. XLU, very similar. Wish I had more buys here, but I don't have a lot of long signals other than UNG, right? Because the market's just so overbought. Here we go. Swing high, swing low, higher swing high, market structure change. We are smack dab in the middle of the order block. The high of the order block is 83.41. The low is 81. If we reject the high of the order block, potential short. If we reject the low of the order block, potential short. Last but not least, everyone. Oh, this one is bullish. Thank goodness. Got some green. Okay, I am really looking at this. I really like this potential trade. You see green, that means I'm looking to buy. Why? Well, all the way back here, this is all the way back to 2023. We have a low, we have a swing high, we have a lower swing low, and then we change structure to the upside. Defining the bullish order block here, the high 128.40, the low 122.59. We run that out into the future, and voila. Was this a legitimate entry on Friday? It was, because it rejected the bottom, or the top, excuse me, of the order block. Now, did I take the trade? I did not. Why? Because the risk to reward is not very good. Yes, we rejected the high of the order block. Yes, it is a legitimate entry, but my stop is a close below the low of the order block. You see how that's quite a long ways away, right? Now, maybe this just takes off, goes forward, I missed the trade, that's fine. But what I'm really keying off of here, everyone, do you see the 300-week moving average inside of the bullish order block? This is what I'm looking for. Next week, two things. If we go down, reject the high of the order block again, but close above it, but not as high as we are here, now it's a better risk to reward. I would certainly consider buying there. I would certainly consider buying the bottom of the order block at about 122.62. But the sweet spot for me is the 300-week moving average, which by itself is a strong level of support that also lives inside this bullish order block. And that 300 is where? 126.12. 126.12. So I'm really going to watch XLV closely. Look, pharmaceutical companies like Merck, Pfizer, the healthcare industry, all very oversold. The rest of the market very overbought. It's not just as simple as buying the industry that's out of phase and shorting the industry that's overbought. No. But these oversold industries like healthcare are coming into some major areas, and the prices are much lower. That's why I'm so interested. So anyway, everybody, that's it for today. I appreciate you being here. I hope it was helpful. If you have any comments, put them in the comment section. I'll do my best to answer. If I can help you with your trading, I would love to have you as a student. Just send me an email. We can get the conversation started. That deep dip buy video series lessons that I have on udemy.com, that link is in the description if you want to go that way. But love to teach you one way or the other and help you with your trading. So please reach out to me. If you like today's podcast, hit the like button, and please try to go out and do something nice for somebody every day. It would make the world a lot better place. Please try to go out and do one nice thing for an animal every day. They appreciate acts of kindness just like we do. But I appreciate you being here. Stay safe, follow your trading plan, and God willing, I'll see you next week. Thanks so much, everybody. Appreciate it. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.